This week, the Federal Resources Minister Madeleine King took aim at the world's biggest diversified miner over its criticism of Labor's industrial relations changes, like same job, same pay, and also industry-wide wage negotiation, forcing it then into negotiations with unions in the Pilbara. King, who is pro-jobs and pro-mining, spoke at a lunch at Western Australia's Chamber of Commerce and Industry. The Chamber itself said every business in Australia that employs people will be impacted by the significant changes to workplace laws that came into effect this week. King was then asked if the changes create a risk of significant industrial action or strikes in the Pilbara, where the iron ore is mined. She said industry needs to work with unions, and then squared up and took direct aim at BHP, saying it always railed against Labor policy whenever in opposition or in government.
Pulling the BHP card, which is to go to the Murdoch press and pull up another thing that they don't like about how the Australian Labor Party in government will work in the interests of workers.
Sky News, of course, controlled by the Murdochs, but this week BHP's profit, up 2% to $13.7 billion, showed no government can presume large companies will simply keep on investing here. But there are warnings from this report for high-cost iron ore miners about BHP's potential expansion of its copper assets and the consequences of Australia's new industrial relations laws. Well, BHP Chief Executive Mike Henry chose to speak with us this week. So I asked him about the IR changes and whether they could prevent BHP spending tens of billions of dollars to expand its South Australian copper assets.
We've been clear and vocal for a number of years now about the need for Australia to maintain policy settings that enable it to compete globally. And we're not just focused here on the resources sector or on BHP, we're talking about the economy more broadly. We recently released a report in this regard talking about the opportunity ahead for Australia, but for Australia to capitalize on that, it does have to have competitive policies in place that stimulate competitiveness globally. Now, if we look at our sector specifically, BHP has been very clear that we support rising wages to the extent that there's a link with productivity improvements. And our concern about some of the policies that are being put in place right now is that they bring extra cost, less flexibility, and certainly no productivity improvement. And that isn't a long-term trend, or that trend isn't going to be good for Australia in the long term. Now, exactly how it plays out then in terms of our investment decision-making really depends on a whole range of other factors. It'll depend on how we see commodity prices, the resource quality, the cost of capital, and so on. And then, you know, at the end of the day, for something like Copper South Australia, we need to bring all of that together, look at the risk and returns for that project versus the risk and returns for projects elsewhere in the world, be they in copper or other commodities, and we'll be guided by our capital allocation framework then in determining where best to invest. There's no absolute deadline, but what I will say is in 2027 and 2028, we have a major maintenance program planned for the smelter at Olympic Dam. That's the natural time when you would want to undertake any major activity like the move to two-stage smelting and the expansion that we've announced. So it would be in the lead up to that time when we'd expect to have studies completed and ultimately be taking a final investment decision.
But Mike, look, you've got other opportunities in Chile and in Argentina, even Arizona, where you could develop copper. So you've got optionality, you know, but you've still identified copper as a key area for the energy transition.
We do, Ross. We've got opportunities around the world. Ultimately, we want to pursue more, a multitude of those opportunities, and we've got the resilient balance sheet and cash flows to support that. But every project has to compete for capital under the capital allocation framework, and we're advancing a number of these options in parallel.
So start with the notion of iron ore prices. They've come down. China is cooling. With higher cost operators, is it inevitable you think that some will have to close? After all, Mineral Resources shut down its iron ore mines back in June. So are there others to come?
On the specific question of iron ore, I'll start by saying that BHP has the lowest cost iron ore business in the world, and we've worked very hard to get to the position that we're in. We're passionate about operational excellence, and you see that coming through yet again in our results, where we've extended our lead and our cost lead within the sector. Now, there is a bit of price pressure out there, as you say, due to the current state of things in China, where one segment of steel demand, which is the property sector, it makes up about 20% of demand, is under a bit of pressure. That's brought a bit of downwards pressure on prices. But we do see a cushion on the downside on prices because there's a fairly significant bench of high-cost supply sitting in the $90 to $100 per ton range. But as to your question about, well, what effect does this ultimately have on higher cost suppliers? Of course, as prices come off, you tend to see some of that high cost bench come under pressure and ultimately some shut in production or withhold exports. Now, it's a wide range of suppliers that sit within that high cost bench. Some of them are the iron ore exporters out of India. Some of it is Chinese domestic supply. Some of it is indeed in Western Australia. And so we're seeing at the margins some of that supply shut in. And then we've said over the medium to long term, as Chinese moves past its steel-intensive phase of economic development, the steel industry and iron ore demand will come under further pressure, and that's likely to have more significant consequences for that high-cost supply. But in all circumstances and at all points in the cycle, BHP is very well positioned given its leading cost position and the effort that we've had underway to improve the quality of our product suite, which is leading to better realized prices for our products as well.
So this week in the result, you called out the slowing of China's slowing demand, but the increase in Indian demand is still to come. But India, of course, has an iron ore industry of its own that produces right now what it needs. The big question is whether cheap Australian iron ore exports will replace that Indian production.
So India has a wonderful growth story ahead of it. It's currently the largest or the fastest growing large economy in the world, but it is going to need a different mix of commodity imports than China has needed. As you say, Ross, it does have indigenous or domestic resources of high-quality iron ore. That's expected to make up the large majority of their demand or meeting their demand going forward. Whereas in the case of coking coal, India doesn't have domestic resource of high-quality coking coal, so it's going to be more reliant upon imports. And you'll see that within the BHP portfolio, in addition to all the work that we've had underway around building up a portfolio of attractive growth options in potash and copper, we've also taken our coal portfolio and reshaped it such that it's now centered on just the best of the best quality coking coals or coals for steel making. And that's because of the Indian opportunity that we see ahead, as well as the belief that we have that steelmakers around the world are going to increasingly need high-quality products to help with their decarbonization efforts. So we've got a great business in coking coal, more focused on high-quality products, lowest cost, best position in iron ore, and an increasingly exciting growth story in both copper and potash.
So, Mike, just a question for you. Have you changed any of the mega trends that BHP identified a long time ago, which are the driving goals for how you invest? These are increasing decarbonisation, population growth, rising living standards and urbanisation. Is there anything more that you're seeing, especially around the ageing of China's population?
No, Ross, we've been clear and consistent for a number of years now, and what you're really seeing from us is just a consistent execution of the strategy that we've laid out. Focus on operational excellence, delivering social value, and ensuring that we've got a portfolio that is shaped to benefit from those megatrends that you just called out. And that's really what you can see coming through in this set of results.
So can I talk to you about that Anglo-American deal that didn't go through? Does that now mean that BHP is now not open to other deals? The other one that I think is obvious, it's about the same price, is Freeport-McMoRan. So if you wanted to acquire copper assets without having to develop things like, say, the South Australian assets, you could go there potentially.
So Ross, we've been clear, we are not driven by the need for M&A. First focus, plan A for us, is get more out of these wonderful resources that we have through ensuring that we get greatest returns from the capital we have deployed in the existing business, and to look at organic growth options. And you see a lot of, a number of those laid out in this presentation. In respect of M&A, given our strong underlying performance in the business, of course we've got the ability to pursue it, but we will always be very disciplined about how we go about it, and only where we see that we can create value for shareholders. So it has to be the right commodity, right assets at the right price where we can unlock value for shareholders. We thought there was a great opportunity in what we had proposed for Anglo for both sets of shareholders, but they've elected to pursue their own plan, and we stay focused on plan A, which you see laid out in this set of results.
Mike Henry, always great to chat to you. Many thanks for your time today.
Thanks, Ross.